Hey guys, Dave Keller here with Market Misbehavior. Today we're going to talk about volatility and in particular the VIX. The VIX is often referred to as the fear gauge or the fear index. It's really more about uncertainty, and we'll talk about volatility regimes and why the VIX right now is nearing a key level in early August. So I'm often asked about volatility, and often people refer to the inverse relationship between stocks and volatility. When stocks are rising, volatility tends to dissipate. When stocks are falling, volatility tends to increase. We'll look at the chart. We'll talk about that dynamic, that traditional inverse relationship between stocks and the VIX. However, the VIX right now is nearing a very key point that has to do with what I call volatility regimes. I'll explain what that means as we look at the chart here in a moment. Before we get there though, if you like this sort of thinking about technical analysis, behavioral finance, price, trend, momentum, breadth, all of that stuff, if that's of interest, I hope you will subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. What do you see next for the S&P? Do we get above 4,200 and stay there? Or is this the end of the bear market rally? Let me know in the comments, and let's get to the chart. All right, so this is my chart of the VIX, and I usually look at the VIX in the top half and the S&P in the bottom, because for me, volatility is all about the relationship between the VIX and the S&P 500. Now, the VIX is often referred to as the fear gauge, and while I get the argument for that, because there tends to be an inverse relationship, when the market really tanks, volatility tends to spike, and we certainly saw that in the first to second quarter of 2020. However, the VIX isn't actually measuring fear. It's not really quantifying fear. It's quantifying volatility. It's quantifying risk, or maybe another way, it's quantifying uncertainty. It's quantifying how much things are expected to move. It's literally the implied volatility for the S&P 500. It's using the S&P options market to imply a volatility for the underlying instrument, in this case, the S&P 500. So it makes sense, doesn't it, that when the S&P 500 is going up, that volatility tends to be low. And we saw that most recently in mid-2021, right? Market in a consistent bull market phase. 2021 was just an epic bull market year, brief pullbacks, but not much. It was pretty much long and strong up and to the right. There's not a lot of uncertainty. It's sort of this nice, consistent uptrend. So as a result, volatility is very low. People aren't panicking. People aren't nervous. Pretty mindful, pretty laid back, and enjoying the bull market phase. Look at what happened in 2020. Look at what happened in 2022 when the market starts to sell off. Particularly, one of the better examples is late 2019, early 2020. The VIX was incredibly low. It was almost down to single digits, down below 15, which is pretty low based on the historical averages. As the S&P made a new all-time high in February of 2020, then we had the COVID crisis. Things rolled over very quickly. We gapped lower and accelerated for the next 4 weeks to make a significant low in March of 2020. Look at how the VIX spiked from around 13 up to around 83 in just about a month. That is a huge swing for volatility, one of the highest readings in the history of the VIX. The reason why that happens is because when the market's going higher, you don't emotionally, in a panicked way, accumulate shares. Just kind of slowly build a position. Everything's fine. You're a little more laid back about it. But when things start to look ugly, you don't often, and traditionally, investors don't just sit back in a very calm and rational way and gently hit the sell button as they exit their positions. You freak out, you panic, start sweating. You get these physical, visceral reactions to the fact that price is going down and your paper losses are mounting, and you panic. And you don't panic and sell a little bit, you panic and sell a lot. That feedback loop, right, of panicking leading to more selling, selling leading to more panicking, is why bear markets tend to be very sudden. And while bull markets tend to be a little more drawn out, a little more sustained, I was told by one of my mentors, Ralph Akinpora, stocks take the escalator up and the elevator down. They sort of slowly go up, and then kabam, you sort of distribute very quickly. That's why sell-offs in stocks, particularly brief and quick sell-offs, usually are coincided with a spike in volatility. And we can see that, right? If we look at this relationship, when the S&P is going down, the VIX tends to be going higher, and the opposite, right? But let's look at a couple parts of this time, right? This chart is really separated, I think, into 5 phases. The first fifth is sort of late 2019 into the February market high, which is a period of relatively low volatility. Then you have the sell-off into the March low and a huge spike in volatility, which is sort of an unusual, sort of a one-off event there. This third phase, what I call a volatility regime, sort of mid 2020 to early 2021. In this case, the VIX ranges from around 20 on the lower end to 40 on the upper end. Look in mid 2021, the entire range of the VIX comes down, and all of a sudden we're at 15 on the lower end, 25 on the upper end. Now we're in what I would argue is the fifth phase on this chart, which is volatility is elevated a little bit, and you have the lows around 20 and the highs around 30 or 35. So during a certain volatility regime, if you take these last three periods, sort of mid 2020 to early 2021 as a period of elevated volatility, low volatility in mid 2021, that's our second period. And then the third period, you can see that the choppy, uncertain period, sort of that 6-month period, 8-month, 12-month period after the March 2020 low, even though the market was going higher, the volatility is still elevated because there's still a lot of uncertainty and people were still very nervous. This is the midst of the early pandemic days. We were like wiping off our grapes from the store at that point, right? Cleaning off our cereal boxes before we ate them. This was peak of the uncertainty around the COVID pandemic. 2021, things sort of settled into a normalcy, right? We're all kind of working from home, getting used to that. We sort of understand how to protect ourselves, protect those around us if we choose to do so. As a result, the market goes into a sustained recovery period. The Fed is being very supportive. Volatility is coming down because we're sort of building confidence in the sustainability of that bull market phase. 2021 into 2022, talk about two very different markets, right? The market did one thing going into the end of 2021, totally different. Talk about an uptrend reversing to a downtrend as this year started. This is when we start thinking about the Fed. Now we start to digest the realities of the Fed raising rates and all of the subsequent things that means. As a result, the volatility regime has gone higher. So during a particular volatility regime, it's not hard to identify price peaks and price valleys. So for example, if you look at this first of the periods that I highlighted from mid 2020 to early 2021, if you sold every time the VIX got down to 20, and if you bought every time the VIX got up to 40 or 35 or 40, pretty much picked some of the key turning points during that period. In 2021, if you bought every time the VIX spiked above 25 and sold every time the VIX got to around 15, same thing, you did pretty well kind of picking the peaks and valleys. In 2022, the game's been easy. Buy every time the VIX goes down or goes up above 30 to 35, sell anytime the VIX gets to around 20, and that's pretty much been the playbook. So during a particular volatility regime, particular levels in the VIX tend to coincide with peaks and valleys, because it's not just about one move and a change in the VIX. It's about the overall change in volatility, or again, what I call a volatility regime. Let's take it to where we're at today. The S&P has rallied in a very meaningful way from a low just above 3,600 to now reaching into that 4,150 to 4,200 range. Now, in my work, I've been talking a lot about this range because of a couple of reasons. Number one, that is the high from end of May, early June. That's the last most significant swing high in the S&P 500. It gets above that level, you can really start to believe in the sustainability of this bull market run. However, the last time we did this sort of new lows, then a higher secondary low, and then a quick sudden rally over the next couple of weeks, that was in late March of 2022. That's when we lined up with the February peak. We got up to right around 4,600 for one day only. We closed above that level. Then the price was very quickly repelled. The market moved lower, ended up making a new low about 6 weeks later. Look at what the VIX did there. That's when the VIX hit 20. It also hit 20 in February, which is that peak. It did not get that low in the June peak, which is notable. But here, once again, we're right back to that 20 range. So as the VIX nears 20, we are right around where we were at the March peak and also at the February peak. That's concerning to me when we think about the strength, the sudden move off of the lows that the S&P had. It's drawn in a lot of investors believing that this is the bear market is behind us. We're now in a new bull market phase. What concerns me, this is exactly what we were saying and exactly what we were thinking and exactly what we were challenged with in late March. That was the end. That was the end of the move. The VIX got to 20. The price stalled out at the previous highs and rolled over. That's why I think the S&P is at a key pivotal level. So at this point, I'm inclined to think that something that happened in late March, while we might not have the exact same follow through, I don't think it's unreasonable to expect that the S&P could roll over here, 4,200, maybe a little bit more at best, and then we roll over and potentially test the previous lows, if not undercut them down to 3,600 or beyond. What would convince me that's wrong? A couple things. Number one, S&P above 4,200, the NASDAQ above its June highs as well, and both of those stay there. It's not enough to just get above it, which is what happened in late March. You'd actually need to power above that, have what I call a follow-through move to confirm that uptrend. Number two, the VIX would not bounce off of 20, which is what a top would probably look like. You would need to get low and stay low. Get below 20 ideally and stay below 20, which would tell you not just the market's rallying, but it's continuing to build. It's more of a momentum shift like we saw in mid-2021, indicating a change in the volatility regime. For stocks and risk assets to materially increase from here, I think you need to see volatility remain relatively low, which would indicate increased confidence, increased belief that this bull market certainly has upside potential. Now, we've seen that with individual names. If you look at the charts of Apple or Microsoft, they were attempting and succeeding in the case of Apple, getting above their June highs, but the S&P has not done it yet. That's why looking at a chart of the S&P along with the VIX is key here in early August. So there we go. That's a quick primer on volatility, the VIX, what it means relative to the S&P 500, volatility regimes, and the idea that the volatility range will shift every 6 to 9 months or so. We're getting toward the end of that sort of average period for volatility regimes. So my question is, does the VIX hold at 20? Does it stay below there? Stay low, get low and stay low. That would indicate high probability the S&P is going to go higher from here. If, however, we get a bounce, just like we did in March, just like we did in February, I would look out below for the S&P 500 because there's a possibility we retest the lows for 2022. What do you think about this breakdown of the VIX? Do you agree with my assessment of the S&P, and what do you think happens next? Does the S&P blow through 4,200 on the way to higher highs, or is this the end of the bear market rally before the bear market continues through the course of 2022? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well and be safe. I'll talk to you again soon.